Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Yesterday, we got a question about Roth IRAs, and the question was, with the ability to withdraw money from your Roth IRA without taxes and without a penalty, could it be a good option for emergency savings? So in this video, we need to talk about what a Roth IRA is, does it make sense to use it as an emergency account, and what are the pros and cons to doing so. So first, for those who may not know or didn't catch yesterday's video about what a Roth IRA is, a Roth IRA is an investing account. It's one of the most popular, most powerful investing accounts that is available for people here in the US. And the reason why that is because you're able to put money in today. You've already paid taxes on that money. Put the money in today, and at age 59 and a half, you're able to withdraw that money without paying any taxes, which means that if you start early enough, you're able to invest and grow the money tax-free for decades, and then take the money out to spend it on whatever it is you want to. I mean, you've compounded 20 or 30 or even 40 years in some cases of money, and you don't have to pay taxes at the end, which can be an incredible driver for wealth. Now, right now, really going into 2023, the limit to put money into a Roth IRA is $6,500. Now, again, these limits do adjust every year or so based on what Congress and the IRS want to do. But right now, going into 2023, $6,500 is the maximum that you can put into a Roth IRA. If you are 50 or above, you get an extra $1,000 called a catch-up contribution to put inside that account. Now, the other thing too that is extremely important, it's really going to affect my answer, is this. Once you have the account open, you're putting money into it. Remember, the purpose of this is to invest the money, not just to put money in there. So you want to take the money, put it in the account, and say, I want to go buy X stock. Now, if you want to know what stocks that I like, y'all know I did a whole video on dividend stocks and what stocks make sense, what stocks I think make sense, especially going into 2023. So aside from that, you want to put it perhaps in something like that, grow the money. You start off with $6,500, you're consistently putting money in, and you end up with $1 million, right? And then imagine having $1 million that you can just use and pay zero taxes. Again, that's the beauty of a Roth IRA. So the question again is, well, I get to take out, and the rules and the benefit of a Roth IRA is you get to take out the money that you put in without taxes or penalties, unlike a 401k. Let's say I put in 10% of my salary in a 401k, and I'm 30 years old, and I say, hey, look, I got something going on. I got an emergency. I got to fix my car. Let me take out $5,000. Well, guess what? The IRS is going to say, look, you owe us a 10% penalty, plus you owe us income taxes on that because we don't want you touching that money until you're 59 and a half. And a Roth IRA, you put in $6,000, you get to take out $6,000. Whatever you put in, you can take out with no limits, which is a little bit of a flexibility measure, right? So does it make sense to use it as an emergency account? My answer is no. My answer is no. And there's one tiny instance in where it could make sense, and I'll explain that. But generally, no. And the primary reason is this. What happens if you take the money, you invest it, which is what you're supposed to do, is what it is there for, and you just happen to run into a situation in a year like 2022 when the market is down, or you invest in something on an earnings day and the market drops, or the stock that you invested in drops, and you don't have the money that you expected to have. You're supposed to have 3 to 6 months of your expenses put into a savings account, which means that something happens to me, or something happens where, a car breaks down, lose job, whatever. I got 3 to 6 months of say, look, I'm gonna be okay for this amount of time. Well, what happens if, let's say my limit, just to make everything even here, I needed to have $6,000 to take care of six months of my expenses, and I'm investing in something, let's say it's Target, that has not done well this year. Let's say that this is early 2022 when Netflix was down 25, 30, 40%, and I start off with $6,000 and it drops to $3,000, and I'm hitting emergency. I went from 6 months of safety down to 3, and every single day that safety margin is either really good or really bad. And it's probably not a situation that most people should be in just based on a whim, right? Based on, it could be Jay Powell says something, it could be bad earnings, it could be any number of things affecting your emergency savings that you could need immediately. The other part of it too is, remember, when you sell a stock, we have what's called T+2, which means you sell on, let's say, Monday, that's the trade date, then you have 2 days, so Monday, Tuesday, Wednesday, when those funds settle, which means that I can sell today for $3,000 to get the money, but it may not hit my bank account, and I may not be able to use it until Wednesday. If this is a dire situation, it could be a few days for you to get that money. And imagine too, if you are, let's say you're banking at, or you have your investments at Fidelity or Robinhood or wherever, and you have a bank somewhere else. So now I have to take that money, it's settled on Wednesday, and I need to transfer it to a bank account. That could be another 2 to 3 business days, and that's just standard. So emergency happened on Monday. I sold on Monday for a loss. And then it's gonna take me from Monday all the way to Friday to get the cash to use for whatever it is. If it's a car that's broken down, that's a week that I can't get to work, right? That's a week that I can't do whatever it is I needed to do, and I have to sit down and wait for the emergency to be resolved, whatever that thing may be. That's a dangerous situation that I don't think we should be playing with our Roth IRA. So your solution, in my view, is to use things that were built for that thing. So for example, I would put it in a regular savings account. You can call it a high yield savings account where you get paid a tiny bit more interest, 1 or 2% or 3% in this particular interest rate environment. Put it there so that you can get to it almost instantly. When I transfer, if I got on myself at Ally Bank, I transfer from savings to checking, it's instant. And I can use that money right then and right there, and I don't have to worry about taxes. I don't have to worry about penalties and all that type of stuff. If the money is there and I can use it immediately, that is what a savings account is built for. So it's best to use those things that are built for those things to do the things that you need to do. So that would be my the way that I would structure it. The other thing here is this. There is a scenario in which, let's say you have all of your stuff together, right? You have your savings, you're investing, you're doing all this stuff, and you exhaust your savings. It's a huge emergency, something very unfortunate, which God forgive, we don't want that to happen. God forbid, rather. So you have to exhaust your savings, and then, as opposed to going to credit card debt, you definitely don't want to do, then you have to go and withdraw a portion of which you put in to a Roth IRA. Okay, that makes sense, right? You used your savings to what you were supposed to use it for, and let's say you only need another 500 or 600, and you put in 500 or 600 to a Roth, you take out that 500 or 600. I think that's okay, right? That makes sense. That is one of the only times I think it will make sense, but you definitely don't want to have to rely on it. And also, by doing so, that's not free money. Right, it's that when I say it's not free money, that's when you take that $500 out of the account and you've sold off a little bit of stocks or whatever. Remember, that's less money that you're going to have to grow in the future unless you almost immediately put that $500 back and allow that $500 to grow. That's called opportunity cost, because what that $500 would have done over 20 years or however long, or whatever number you take out, compared to what it would have done if you had left it alone, right? Or if you had taken out and did something else. So short answer, no, it does not make sense in my view to use it as a savings account. It can be a buffer if your savings account has been exhausted. But again, use these tools and accounts in the way that they were built for. Your savings is built for savings. Your checking account is built for buying stuff. Your investing accounts are built for investing. And then your insurance accounts, your insurance policies are built for insurance. A lot of people try and take insurance and try and make it an investment and all that kind of stuff, and it doesn't really work out. So use each of them really just plainly and use them for what they're most efficient for. The way I like to think of it is like I could take a plane, right, a commercial plane or a private plane or whatever, and I can drive it on the street if I chose to. I think that was like a plot in one of the speed movies from like the 90s. You can do that. And you're gonna go real fast. But are the roads built for a plane to be on the street? No, it is not, right? But you can do it. It just doesn't make the most sense for you to do. Can you take, I don't know, a Mustang convertible and go off-roading? I mean, you can, but again, there's something built for that, right? There's something built to go on the road. There's something built to go off-road. So use those tools to be most efficient for that, as opposed to kind of like combining and kind of putting things together on the side to, make it do what we need it to do. So again, everything has a purpose. I think just use your savings account for emergency savings, use your Roth IRA for investing. And if you ever exhaust your savings, then it makes sense, or it could make sense rather, to use a portion of your Roth IRA. But hopefully that we don't run into that, and you want to make sure that you have that 3 to 6 months of your expenses inside of a high yield savings account. That's just a savings account that pays you a little bit more. One of my favorites is Ally, and even Goldman Sachs has a bank called Marcus. That's an online bank that pays quite well. And then another one is American Express. So those are my three: Ally, American Express, and Marcus, which is from Goldman Sachs. So those are three banks that I would recommend if you're looking for a high yield savings. All right, great question. If you got any more, y'all know I love Q&A. Right, y'all know I love Q&A. So if you have any other questions about money, about investing, all that stuff, feel free to let me know. Also, we are doing a new video, as we do every single week, inside the members only. This week I'm going to go over some of the math behind trading and why it makes sense to pay attention to the prices that you're paying if you're looking to trade, and how it can make a very significant difference. Just a $2 or $3 difference can really make or break your trading plan and really make or break your profits. So I'll be finishing editing that one tonight and probably post it tomorrow. So you definitely want to join that, as well as checking out our dividend stock video and the stock that I broke down that is up 20% and pays an additional 2% dividend. It is delicious. We've talked about it before, so you want to make sure that you get that. But all that is inside the members only, and that link is right here. All right, that's it for me. I'll talk to y'all tomorrow. Bye.